Boom, 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 boom. Hello. Hello, friends. Mic check. 1 2 1 2. See a bunch of people in the chat already. Hello, everybody. How you doing today? What's the deal? All right. Let's go. Hello. Hello. Welcome, friends, to Alpha Beta Soup. I'm your boy, TX M Sizzle. What's the dizzle? Hope everyone had a great Christmas. Been looking forward to doing this last stream of the year. Lots of green in the chat. You know, before we even started broadcasting today, we had homies hanging out in the chat. We had memberships being given. The spirit of giving is upon us. Sick Thinker gifting memberships before we even started today. Eric Martinson gifted a membership before we even started today. Welcome, everyone. Brandon Hammond, Blockproof, XP Market, Mr. Six, Arati, Frankie. Welcome, everybody. BT. I see blockchain backers in the chat early today. What's up, my guy? My name plus some numbers. What's up, man? Excellent, excellent. This is the last stream of the year. It's the last trading day of the year. The 2023 candle on the S&P only has 4 hours left on it. And everybody on my TradFi feed this morning, all they care about is this box going to close taller than these two boxes? Forget anything else going on today. All we're watching is whether this line finishes taller than these lines. Obeid, I see you, my guy. What up? It's been a strong year. You know, when I think back to like how the year was starting out, and where we were like at the end of 2022, there was, you know, most of equities, most of TradFi was extremely bearish. We had just come out of a crypto winter, right here, right around this point on the chart on the S&P right here. It was right around the time FTX collapsed. And sentiment couldn't have been possibly any worse. You know, we were even dipping down at one point. We were touching the 200 week. Here's the 200 week on the S&P. We touched it on the Dow Jones. Everything kissed it late in the year. You know, we had the gilt market blowing up over in the UK, right? Their yields skyrocketed in like late September, early October. We didn't really know what was going to happen over there. We had some interventions from the Bank of Japan as the, where was it? As we had the yen ripping up to levels that hadn't been seen in a long time. All of this was the end of last year. And it happened while most people in TradFi had a recession thesis. And so everybody was on one side of the boat, right? They were all on the bearish side of the boat. We're going lower. We kissed the 200 week. This is the dead cat bounce. It's all going to Hades. We're going to have a recession. The consumer is going to collapse. There's no way the government can fund itself at these interest rates without turning into Weimar Germany, etc., etc. Crypto will never recover. And all we ended up getting in 2023 was an eye-bleeding ripper across a lot of risk assets. Not everything. You know, the Russell 2000's been lagging behind for most of the year. This represents small caps in equities. They did break out here over a long range that they had been consolidating in. But for most of the year, they've been underperforming. But, you know, S&P, amazing year. NASDAQ, one of its best years in a really long time. What was the return on the NASDAQ this year? I guess let's look right here. 53%. On the NASDAQ this year. Absolutely insane. And where we stand right now as we enter into 2024, the sentiment here at the end of this year is diametrically opposed to the sentiment at the end of last year in every single respect. There's no, you can take any aspect of what the market thought at the end of last year and you can flip it on its head, and that's exactly what people think today. And you guys who've been following me for a while, you know what I think, which is that we have not seen the end of this cycle. And where we are right now, when we have equities, we have NASDAQ at all-time highs. We've got the Dow Jones also at all-time highs. We have the S&P, as we just opened the stream talking about. The S&P is lagging behind, but it is right there. And the vast majority of people who had a recession thesis have given it up. We have max bullishness. We had record inflows to ETFs, including the SPY last week. If you look at bull bear sentiment indicators, which I don't have access to that data, but some people in the industry do, all of those things are showing max bullish positioning. The put call ratio I just saw for the S&P is at like one of its lowest levels ever. And the VIX is below 13. Let me look at this on a weekly. The VIX is below 13. You know, everyone is short volatility to the moon. And I think we're actually entering probably the most dangerous window of this entire cycle. It wasn't 2022. I spent all 2022 talking about how the end of the year and into next year was going to be pretty scary. Now, what I think I did a poor job of as an analyst and a talking head on Twitter, for lack of a better term, is that I didn't recognize the potential for a really bullish 2023 in the face of what we thought was likely to happen at the end of the cycle when it came. And so for that reason, I think I have a big learning in understanding how long I knew the perspective of how long these cycles take. I had a feeling that, you know, the recession wasn't just going to start right here in September of 2022. This is around the time I started building my data set and really started to understand this process could be quite long. You know, this could take 18 months, 2 years from the time the Fed starts tightening. And we were just, 9 months into a tightening cycle at the end of last year. So there's definitely a lot of learning for me for 2023, but it doesn't have anything to do with being wrong about the economy. It's more about being wrong about how bullish the market was capable of being until it is given a reason not to be bullish. And that's been a fascinating dynamic to watch this year, because the market has in a lot of ways climbed a wall of worry, driven by different narratives. AI was a big piece of it. After we had the banks blowing up in March, that narrative really took off through the summer, through this leg of the S&P right here. That was when the NASDAQ did some of its, It's when the NASDAQ did some of its strongest running. See, this is when SVB collapsed around in here. And this was, a massive run on the NASDAQ. Let's see. Let's see if we can measure this out. No. Oh, not days, price. Yeah, just from March to July, the NASDAQ ripped 35%. That's insane. And all this time, economic data continued to be less than exciting. We had some strong, we had some strong GDP figures, but the rates of growth in jobs continued to slow down. Rates of consumption continued to slow down. And a lot of this was driven by CPI falling and the market seeing what the Fed did in response to SVB and assuming that they were going to backstop the markets in the case of any bad things happening, right? It was the revival of the Fed put, and we climbed a wall of worry. And here we are at the highs. And I think 2024 is going to surprise people, because there are some headwinds that set the stage for a surprise of some kind. And that's usually what happens late in a cycle, right? We often get some kind of a surprise, right? Like the economy isn't just going to drift into a severe recession through 1,000 paper cuts without any surprises at all. And I think that some of the things we can look at today help set the stage for what troubles could be next year. And a lot of those relate to the debt markets, to credit markets, and to the massive chasm between what the market thinks the Fed is going to do with interest rates and what they are actually likely to do with interest rates and what the market needs. Like, all three of those things are in very different places. The market's expecting 125 basis points of cuts. The Fed has signaled less than that, and the market needs much more than that. And those things will begin to play out into next year. It's hard to forecast that. And that isn't a call for the market, right? Because the market can kind of look through individual little problems now and then. But if we think about the credit market as a whole, most of corporate America has not refinanced at the new cost of money. And those things will begin to happen in 2024. The stage was not set for those things to occur in 2023. That's next year's business and on into the future. And we talked some about that last week, right? If you guys recall, we looked at this chart last week, and I actually explained this in quite some detail about how most debt was born down here. Interest rates are currently up here. The blue box is what is priced into the market, which is really aggressive if we're going to get a soft landing. 125 basis points of cuts in an expansion year with a strong economy and tight labor in a cycle where we've had inflation is a really aggressive expectation. And even that amount of cuts would not take the market anywhere near where it actually needs to get to for the new cost of money to not be punitive, to not eat into margins and things of that nature. So that's a dynamic that we talked about here, and I don't think is getting quite enough coverage in the broad TradFi, FinTwit, space, people that watch the markets. But there is a guy who I heard talking about this. I watched a video over the past week, and it was from Mike Wilson, who is the head strategist at Morgan Stanley. I talked about him before. I talked about him being one of the most respected analysts on Wall Street. And last year, he flipped bullish at the highs, which was a really bad mistake for him. He flipped bullish up here right before we had a pullback in the markets. But he's someone I think is really interesting to listen to. And I'm going to play a little clip, about a minute, of this interview with Mike Wilson. And he talks about the exact dynamic that I have been explaining to you guys about refinancing, about Fed cuts next year, and that the market isn't quite pricing this reality appropriately. So let's listen to Mike Wilson. And if you'll recall back to our stream last week, he says many of the things that I explained just a few days ago.
But Fed funds has gone up at a pace that we have not seen in 40 years, right? And if it were to stay above 5%, what I'm saying is, isn't that like really restrictive in and of itself, that spread between the 10-year and Fed funds?
Yeah, I mean, the higher for longer is when it starts to really bite. And the reason we didn't have a problem this year is because we haven't had to refinance corporate America yet. Right?
We haven't had a problem yet because we haven't refinanced corporate America yet.
Right? That's next year's business. Right? I mean, people have termed out their debt. Mm-hmm. By the way, most consumers' biggest debt is their mortgage, which is fixed. So that's why it hasn't really started to bite yet. But it is starting.
That's why I keep saying that the market, the economy, is not operating at 5.5% Fed funds rate. It's operating still in the 0 to 2.5% Fed funds universe that we lived in for the last, 10 of the last 15 years, give or take.
Starting to bite now. It's starting to bite on interest rate sensitive demand. For example, housing demand, auto demand, anything that requires, borrowing, that really is falling off a cliff now. So next year, if the Fed doesn't cut significantly and 10-year is 4% or higher, and you got to recapitalize corporate America and the Treasury. Okay, that's the big one. If you got to recapitalize the Treasury at 4.5%, 5% over the next 12 months, that's a lot of money. You're going to crowd out a ton of investments. So that's why the soft landing is actually probably the worst possible scenario for stocks.
That's why the soft landing, in his words, could be the worst possible scenario for stocks, because it will not allow the Fed to cut enough to dislodge the refinancing channel. It's literally this chart. Mike Wilson is explaining this dynamic right here to you. And that gives me a lot of pause, especially when we look at the credit markets, as we have on here quite a lot, right? That's something we've spent a ton of time on. The rate of change of credit growth has slowed down faster than any other prior tightening cycle. You can see that here. See this black line? This is bank loan growth on a 6-month annualized rate after the start of Fed tightening. This black line is 2022-23. The Fed started tightening in March of 2022, just right around here. And for part of last year, for the first maybe 6-9 months of last year in that process, we saw credit continue to expand. And there was a pulling forward of demand, because that's what happens when the market sees higher interest rates coming. They pull forward demand even faster, and people try to accumulate credit before rates rise. Right? You want to lock in some of that debt at 3% before they jack it up to 4% or whatever. So we saw an increase in credit at the beginning of the tightening cycle. But on a rate of change basis, about a year into the tightening, which was around March of this year, around the time the banks collapsed, the regional banks, we saw the rate of change of bank loans totally fall off a cliff. And this is really evident if you look at business loans specifically. You can see how this is falling off a cliff. So credit creation coming out of the banks, also on a consumer basis here, is slowing down dramatically. Now, the consumer credit side, while it has slowed really sharply, hasn't slowed as quickly as it did in 66 or even part of 73, 75. But it is one of the fastest halts that we've ever seen in the credit edifice. And so what's ended up happening is that the rate of change of credit growth, which is, let me see if I can find my chart, which means the rate of change of credit growth has slowed down dramatically, right? That's all these lines over here. Business loans, basically flat. Consumer credit slowing down a lot. You can't really see that number, but it says 1.6%. Total loan growth slowing down, real estate loans slowing down. So credit has been choked off out of the commercial banks. But part of what has kept, there's two dynamics. One, the rapidity of the rate rising out of the Fed has allowed businesses to they haven't gotten a chance to refinance. So we just haven't refinanced corporate America yet, as Mike Wilson just told you. But also, what I touched on this some last week, and I'm going to try to tease this out as best I can so that it makes sense. A lot of the creation of credit that allows businesses to continue operating has been pushed out of the commercial banking sector. So when we look at credit growth together and we look at it on these charts where we're trying to model the recessions. Well, here comes my hiccups. Right on time. Remember, guys, every stream I get the damn hiccups. So a lot of credit growth, for decades, the banks were responsible for the vast majority of loan creation, loan origination for businesses, for real estate, for consumers, for everything. But in the wake of the great financial crisis, a lot of regulators cracked down on banks' ability to lend on more risky bases. What that ended up happening was it didn't stop those loans from happening, as is often the case when the government tries to corral a certain behavior. All they end up doing is pushing that behavior outside their walls. That's exactly what they did. So a lot of the riskier lending that goes to less creditworthy businesses, ventures that are perceived to be higher risk because maybe you don't know where the returns are going to come from. Maybe there's questionable cash flows. Maybe it's a new experimental industry. Whatever the case, a lot of that loan creation has been pushed out of commercial banks where the Fed has total purview and regulators have purview, and it's been pushed into what's called the shadow banking system, which it's called shadow because it's not under the spotlight of regulators. It doesn't mean it's something bad. There are a ton of non-bank lenders and financial institutions that are not part of the commercial banking sector. They don't fall under the purview of the Federal Reserve, and those people can create loans. And in the years since the Great Financial Crisis, that industry has absolutely exploded. And we've talked some about this on this channel here, right? I had a it's this quote tweet. Here we go. We talked about this, right? Rate cut pivot can't come soon enough for debt-strapped companies. This is a Bloomberg story. And we talked quite a bit about this. This is tied into what we've just been discussing with the refinancing channel needing to be dislodged. So I've been reading on Bloomberg a lot about this, and this industry is called private credit. There's a lot of these big firms like Ares, Apollo, Castle Lake, KKR. These are huge private firms that have raised many, many billions of dollars over the years, and they have become, in a lot of ways, direct lenders to businesses, and they have crowded out that business that used to belong to the banks. So over the last 15 years, that industry has continued to grow. And there's a couple of dynamics inside of that industry. You can find a lot of these stories on Bloomberg. And as you can see, I've saved a bunch of these stories. I've been reading these. And a couple of things are going on here. The first thing that's going on is this industry has grown really quickly. And because it is eating into market share, banks are now trying to join in on this. And there's a lot of other firms trying to join in on the private credit wave. It used to be something no one really cared about, but now it's becoming quite popular. It's like a new lending technology. And anytime we have bubbles or financial crises, they often center around new industries, right? A lot of the derivative toxicity that was born, that created the Great Financial Crisis, was due to new financialized products, new securitization methods, things like that. A lot of new products we hadn't really played around with. If you watch The Big Short, they talk about some of those things. And a lot of that activity, like I've been saying, didn't just stop after the GFC. It was just pushed to other people. Well, private credit has taken over a lot of that. And the competition has become really fierce. And as a result of that, and in the chase for higher yields, because we've been in a low rate environment, because interest rates have been at fucking zero since 2009, there has been a chase for higher yield. And in the chase for higher yield and in the rising competition in private credit, we are seeing a deterioration in lending standards. Let me show you a couple of these stories. November 2021. Private lenders ratchet up risk as they fight for business. Private credit funds flush with cash and competing more intensely to win lending businesses are increasingly giving up safeguards that protect them in tougher times. This shift is making this debt look more like syndicated loans that banks sell to investors. So what normally happens when banks do a lot of lending is that they do what is called syndication. They package up all those loans, they make a big securitized product out of it, and then they slice it up and they sell it to a bunch of different investors. And each of those investors gets a piece of this massive loan pie. So their risk is distributed, but their returns are also distributed across all of the owners of that syndicated loan market. And that's a really big market. That's been where a lot of leveraged loans and things have taken place out of commercial banking. Well, what's ended up happening now is private credit is now replacing a lot of that business. However, the risk is far more concentrated because instead of these big loans getting chopped up into a bunch of little pieces and sold to a bunch of different investors, they're owned by a pool of capital that is concentrated in one place, or there's only a couple of direct lenders that are loaning to these businesses and taking on this exposure with very similar types of business. They're saying that here. These shifts are making making this debt look more like syndicated loans that banks sell to investors. But there's a key difference. In the syndicated market, money managers end up with a slice of a loan, sharing risk with dozens of others. In private credit, lenders, including standalone funds, make much bigger bets and they hang on to the loans, leading to more potential losses if one borrower falls into trouble. And so that's what this article is about. And they go on, they explain some of the things that are changing. And if you fast forward to this year, all that stuff has continued. Private credit lenders giving up protections to win bigger deals. This story, November 2021. This story, October 2023. Private credit firms seeking to capture market share from traditional lenders are giving up protections as they snag larger financings. So this story 2 years ago was about how we're starting to see a deterioration in standards. They're giving up certain covenants in order to lock in the higher yield, right? And where is it? There was a phrasing that I find. Here we go. Firms are aiming for returns of potentially 8 points of yield, far more than they can earn in other markets, which means that they can only cut the rates that they charge companies so much. So since they are chasing yield, they've promised a certain level of return to their investors, and they don't want to give that up. Rather than charging a lower rate on the loans that they're creating for these businesses, they're just lowering their standards. They're just making it easy. They're just reducing the covenants, right? They have two valves. They can either charge less or they can reduce all of the different restrictions and requirements on the loans. And that's the option that they've chosen. And so what it creates is a race to the bottom in standards because no one wants to give up the fucking yields. And so as competition has increased in this area, as commercial banks are now pushing into this industry, it's creating a lot of competition and we're seeing standards deteriorate. And then if you move forward into now, what we're seeing, it's part of the story that I quoted from over here. Let me see if I can find some of it. Where is it? Sorry, bouncing around a little bit here. And then it would get to what we talked about last week. So the first dynamic is increasing competition is causing standards to fall, and these private firms where risk is more concentrated are replacing what used to be syndication, where they would distribute risk from the commercial banks, right? Well, now we're at a place where interest rates have risen very quickly. You have a lot of businesses that cannot afford to refinance. And so rather than do that, they are taking out more debt backed by their assets that they currently hold. And those new debts are meant solely to allow them to defer paying their interest on their existing debts. So they're basically Ponzifying their own debts in order to stay alive. And you see some of these stories here. Wall Street wants to let junk firms pay interest with more debt. Struggling borrowers turn to private credit to defer interest. Private equity investors face expensive choice, 10% loans just to get cash. Right? These are the stories that we talked about last week. This is happening in private credit in an industry that is now worth over $1.5 trillion. And one of the quotes that I read, I don't know which one of these stories it's in, but one of these quotes I read was one of these private equity firm managers. They said they think that now up to 50% of leveraged loan creation is happening in private credit. So it's not happening over here on these lines of business loan creation in commercial banks. They're happening in an opaque market that we cannot see. In a market that is deteriorating its standards in order to continue to be competitive. In an industry where businesses are trying to take out more debt simply to not pay the interest on the existing debt. This is happening on the way into 2024, where Mike Wilson just explained to you, we have not refinanced corporate America yet. It's this dynamic right here. Rates went up super fast. They're expecting some kind of cuts, but we need to get back down here. That reckoning is likely to play out over the next 12 to 18 months. And who knows when? right? There'll probably be some surprises. And when that happens, I would anticipate more weakness in labor, because labor is already kind of just hanging on by a thread. Much of the job growth and the job creation over the last year has been government jobs, right? A lot of that because of infrastructure spending, right? The Inflation Reduction Act, all that kind of stuff, CHIPS Act. A lot of social services and government jobs have done a lot of the heavy lifting on job creation, and the private sectors have slowed down their job growth. And so if some of these businesses can't refinance, or they're forced to make hard decisions, those things will start deteriorating margins, and they'll have to make cuts in labor. And I just, when I look at all this, I think that the dynamics going into next year are not fully understood. They're not appreciated by the market. And much of the bull case, much of the bull theses that I see out there, they kind of tie into this idea of, well, we've raised rates all this much and nothing's really happened, so we must be fine. And now we can just move ahead. But I think that it's really bad timing, right? Because at the beginning of 2022, we started the Fed tightening, right? Right around here. And that was when everyone started to believe we were going to have a recession. And so all of 2022, they thought we were going to have a recession. And then when we get to 2023, things start turning up. The Fed, they wrap up their tightening right around here, right around the high of the market was the last time they raised interest rates. And we're heading into the end of the year. We're near all-time highs in equities. Everything looks okay. And so people have just given up on the idea that they had back here. And it's because the idea that they had back here about a recession, it was far too early to adopt that idea. As we've explored on the channel here, as we've looked at quite a bit, let me find a good chart to use as a reference point. As we've talked about quite a bit, all the recessions are out ahead of us, or just right now, right? We're getting to the place where we have examples of recessions, but everyone was worried about it back here on the chart. This is a consumer loan chart, but I'm just talking about on a timeline basis. We're at 14 months into a yield curve inversion. The yield curve inverted in October of 2022. People thought a recession would be here before that. They were thinking it would be back here, and we have zero examples of recessions starting that quickly. And so here we are now in 2023. Everyone's just completely given up on that idea when it's actually more relevant now than it's ever been. And that's happening during this setup here, during the setup where the NASDAQ and the Dow are just 5-6% away from their secular fib extensions off of the prior financial crises that each of them went through. The NASDAQ being the tech bubble, the Dow Jones being the great financial crisis. We're only 6% away from the 4.236 extension on the NASDAQ. The NASDAQ has done 6% like this month. 6.5% in the last month. So the current pace is a little aggressive. Maybe it's not going to get all the way up there in 1 month. But over the next few weeks, it's very possible that we have equities climbing up here to the top of these massive moves. We might get a BTC ETF approval right around that same time. We might get the closure of the bank term funding facility that they opened at when Silicon Valley Bank collapsed in March. That might close in March, 1 year after it was opened. And we've got all these just weird catalysts kind of piling up when I think we're right in the sweet spot of when we have negative outcomes in the market. I've stopped sharing quite as many of my recession ideas on Twitter because it's gotten to a point now where people just mock me relentlessly when I share these things. I get a ton of people quote tweeting me, calling me an idiot. And to me, that just screams toppy behavior, right? Everyone is extremely bullish. Soft landing has become the global consensus. Yet we're looking at the beginning of a credit reckoning that I don't think really anybody fully respects. We've talked about it on here quite a bit, and I know I'm going on at length about it. But this is kind of what I'm thinking about going into 2024. I know I sound super bearish. I actually think equities will continue going higher. I just don't think that they're going to go that much higher. And I think that once they reach their highs, they're going to go a lot lower than people expect. I don't think the lows from October are safe on any major index. I don't think they're safe on Bitcoin. The October 2022 lows. November for Bitcoin. So we'll see. We'll see, but this is the setup. And you know what I've been trying to look at, one of the things I've been looking at was, okay, well, if this setup is going to play out, we've already seen the S&P touch its 4.236. It's already done its whole move off the GFC, and it reached it at the beginning of 2022, and it's just been kind of hovering at that level. And part of the idea, I've talked about this with BCB quite a bit, part of the idea is that if this is all going to play out exactly the way that we think it might, you know, with no variance, then what you would think you'd see is the NASDAQ and the Dow Jones outperforming the S&P on the way to the top, because they haven't gotten there yet, and the S&P already has. Let me show you what I mean by the S&P already has. The S&P is there, and it's popped above it because it's not a perfect line in the sand. It's not just going to hit it and that's the end of the generational cycle and it goes straight down. It just means that if you get to the top here, the likelihood that you are near the highs of the cycle are extremely high. It's rare that this line is respected to the pixel. But the expectation would be that we would see the NASDAQ and the Dow outperform the S&P until they all reach their highs, and that their highs are likely not that far away, right? Well, that's exactly what we've been seeing. What have we been seeing? The NASDAQ is at all-time highs. The Dow Jones is at all-time highs. The S&P is not. It's literally happening. You know, maybe it doesn't play out. I don't know. I'm not forecasting. I am providing probabilities. It seems very likely that we are going to get this outcome. And this was like the farthest tail risk possible outcome, right? It was for all these things to happen all at the same time. And so I made a couple of indicators to try to watch some of these dynamics and to try to see if I can make any sense of this, because there's a lot of sharing of names. The Dow Jones, all 30 members of the Dow Jones are in the S&P. So if the S&P goes up, the Dow is going to go up. There are names that are in the NASDAQ that are not in the S&P or the Dow Jones. There are names in the S&P that are not in either of these indexes. So what I did was I made two indicators. I made an indicator that is NASDAQ exclusive names, and I made an indicator that is S&P exclusive names. And what I expected to see while I was making those, what I hoped to see if there was any validity to this idea, this secular idea about the indices, I expected that if I made those indices, I would see the SPX exclusive names far outperforming the names that are exclusive to the NASDAQ, because the S&P has already completed its cycle and the NASDAQ is trailing behind its secular cycle, though it's very close to it. So is that what I found? You're goddamn right it is. That's exactly what I found. So at the top here is the Dow Jones. This middle line is SPX exclusive. These are stocks that are only in the S&P 500. They are not in the Dow Jones or the index or the NASDAQ, excuse me, the NASDAQ 100 NDQ. This red line is NASDAQ exclusive. What do we see? The Dow Jones, it just broke into all-time highs, but it's right near it, right? It's just above the all-time high. The SPX exclusive names are way out ahead. They're almost up to their 1.618 extension off of the bear market of last year, even though they topped around the same time as the Dow Jones. The S&P names are way out ahead of the Dow Jones index. Remember, these are tickers that will not move the DJI, and they will not move NDQ. They will only move SPX if they rise. And that is what we've been seeing. They're near their golden ratio fib extension. The NASDAQ exclusive names are way behind. They topped earlier, They bottomed around the same time, but they're only at the 70% retracement. They haven't even gotten back up to their prior highs. They have a lot of room to run. So this adds a little bit of validity to just the whole idea that perhaps we could see the NASDAQ and the Dow outperform the S&P late in the cycle. And that if they reach their extensions and the S&P is kind of lagging behind because it's already done a lot of its move, its exclusive move, then that would just lend more credence to the whole idea that we're at the secular end of the cycle. So this is absolutely fascinating to me. And one thing we talked about, I showed this bottom one to you guys about a month ago on one of my streams, the NASDAQ exclusive index. And something that was really fascinating about it was how closely it aligned with Bitcoin. We talked about some of this at the time that I showed it to you. And I showed how peaks on these charts, peaks and troughs and reversal points are really close together. And you can even go back into the 2021 market and find some instances of that. And so if we're going to see Bitcoin roll over at some point, you would expect that would happen around the same time as the NASDAQ exclusive names rolling over. Or likewise, if they are going to continue, you would expect both of them to continue, right? Because they've been following each other really closely. When Bitcoin pumped at the beginning of the year, so did these names. Right? Everyone on Twitter is constantly pummeling you with ideas about why Bitcoin's price is going up, and it's always very myopic. It's always very Bitcoin focused. Bitcoin is going up because people understand sound money, because they see all the money printing, because of Fed liquidity, net liquidity, blah, 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 blah. But if you just look at it compared to things in TradFi, they move together a lot. Look at the Bitcoin pump and look at the NASDAQ exclusive pump. Look at this. Oh, it's the ETF. Is it? Is it? Does the NASDAQ exclusive index give a single fuck about the Bitcoin ETF? No, it doesn't. So who knows, right? Like you can't ever fully explain why price does what it does. But when people speak with assurance about why price is doing X, Y, Z, they're probably wrong. It's probably a lot more to it than that. I do want to look around a little bit at a couple of price charts, like high time frame price charts to go into next year. And then there's something I want to talk about related to the soft landing. There's a chart I want to show you in my recession book. But what I was looking at before I got on the stream, what I was looking at was high time frame levels, like monthly high time frame levels on DXY on Bitcoin. And just trying to kind of think about my bias going into the year. And it can always change, right? New information can always change those things. But on the DXY, I think I'm leaning more bullish on the DXY going into 2024. I think it's near-ish to its local low here. This is a pretty important area that it's bouncing off of here. It did go lower than I thought. Full transparency. It's come all the way back down to these range lows here. And I was surprised about that. I didn't think it would quite make it all the way down here. I thought it would turn around somewhere in this area, and it didn't do that. So, it is what it is. But it's come back down to these range lows. And generally, just overall, this is a pretty important area right here for DXY. I think it's more likely than not to find a low right here. And looking at this on the higher time frames, like this is a monthly chart, right? These are monthly levels. And we're above the 50% mark on this big range we've been carving out since basically the early 90s on the DXY. We bounced below it for most of the 2010s. We broke out in March of last year, a bunch of different factors led to this. And we've now come down, we've back tested this middle range, this macro range mid a couple of times. And I am biased more, I would say, I think the probabilities favor the DXY going up into 2024 than they do it breaking down from here, just based on where it is in this macro range and the fact that it has already tested the mid-range a couple of times here. It favors me more, and seeing where it is inside of the 2022 range, it biases me a little bit towards this area. So I think I favor more DXY going higher next year, but that doesn't mean equities just immediately tank, right? The dynamic with DXY is more about whether or not it is trending really strongly or breaking out of prior consolidation. Like this big move here was devastating for equities because it was a strong trend higher on the dollar, right? But then it has been consolidating in a range for most of 2023. And even though we had a couple of periods of the dollar rising, equities overall were very strong in 2023 because the dollar was just range bound, right? It wasn't going anywhere. Oops. Why is this red? Yeah, like that. Dollar was just range bound. So I think just looking at DXY, I think I favor upside on the DXY. Something I thought was interesting though, looking at doing this same exercise, these high time frame monthly levels. So I did this on Bitcoin and Ethereum, and I marked monthly chart. I marked the bear market low close on a monthly chart, and I marked the bull market high close on a monthly chart. And I plotted out quarter marks, 25, 50, 75%. Well, what do you know? The mid-range is about 32,000, 31.5, 32,000. It's right here, right? And you can see that provided really interesting support in the bull market, and then it provided resistance in the bear market. And likewise, this red box is the 2022 range. And similarly, the mid-range for 2022 fit and perfectly split the mid-range of the bull market, right? Or the prior cycle, I should call it. And so that really shows you how important of a level 3132 was for Bitcoin, right? Because it had these two major high time frame pivots, center points, waiting for it right here. And once it broke above it, it was a really strong move after, half a year of consolidation below that. What if we do this same exercise on Ethereum? Same exact levels. Bull market monthly close low. Bear market close low. Bull market close high, monthly chart. Same exact exercise. 2022 range in red. Same exact exercise. Look at the mid-range. Look at that. Look how important this level is for ETH. Look at that. When this level breaks, it's going to fucking send on ETH, I think. I don't know where it goes. I'm not saying it's going to go to all-time highs, but I think it's going to be a very strong move out of here. It's been lagging way behind. And I don't even really care about ETH, but as a trader, this is a fascinating level. You have to admit. This is the same place right here on Bitcoin. It's right here. That's where ETH is. You see that? See how it's the same? This makes sense to you, right? It's exactly the same spot. Look what Bitcoin did. In hindsight, this will appear to have been the most obvious trade on planet Earth. And there are still people out there who will deny that this looks like a good trade because blah, 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 whatever they have to say about Ethereum. But from a trading perspective, when this consolidation breaks, and it tried to just the other day, it tried to. See that strong rejection? Once it finally tried to close a 12-hour candle above both of these levels, it closed one hard rejection. We will get back over there. But it sold off, came back up, tested that 2022 mid-range, and sold off. So I think that's fascinating. I think that's a really important level for ETH. I think that once it gets over this level, it's a moon mission to 3,000. I do have some ETH, full disclosure. I'm long ETH, I'm long Bitcoin, whatever. I'm partially talking my bags, I guess. But from these levels, that looks really juicy. Just thought I wanted to point that out. And you can do this exercise on anything else, but I was focused primarily on the dollar and Bitcoin and Ethereum, just trying to get a bias here. I think there's a lot more upside on Ethereum. If you look at ETH BTC, it's been trapped. It's been trapped in this range, and it just swept these lows and has now reclaimed them on a weekly chart. Who knows if this is actually the low on ETH BTC? It could come down here. It could come down here, you know, to 0.04, 0.045, something like that. We could maybe get one of these, and then it goes, I don't know. This is this is relative to Bitcoin. So it going down doesn't mean that Bitcoin has to fall or Ethereum has to fall for this to happen. It could just mean Bitcoin outperforms ETH over a certain period of time and then it reverses. But I think relatively Ethereum has catching up to do versus Bitcoin into 2024 with perhaps one more dip lower in relative terms, because we kind of have this void here. You know, if I mark out this range, I didn't mean to take that off. But we have a void here. So maybe we fill some of that in and then we go. I don't know, but we've had a lot of closes, weekly closes above this level. We've had a couple down here that were quickly bounced out of. It seems like maybe it wants to find out what liquidity exists in this little zone, below all the wicks. So we'll find out. I'm not trading ETH BTC. I think this is kind of a widowmaker trade, but it is useful to look at. In much the same way that Sol ETH has been useful to look at during this run here for Solana. If you look at Sol ETH, look at that. This is a weekly chart. These are weekly closes from November 2021. Look at that perfect sweep on Sol ETH right there. Absolute perfect. If we go down to like a 4 hour, look at that. Pinpoint. Right? That's really interesting. However, this is Sol ETH, right? This is the traded pair on Binance. But if you do it with market caps, it's way out ahead. Solana has way outperformed Ethereum on a market cap basis. But if you look at it from a Sol ETH basis, like the traded pair, just the prices, the price did a perfect sweep of the high close versus Ethereum. But like I said, it already got rid of it. Oh, dang it. But on a market cap basis, where is it? Crypto cap, Sol, crypto cap, ETH. But on a market cap basis, Solana's way overshot Ethereum, which I think is really interesting. And I think actually, I think now it's like the third biggest one on the rankings. Oh, no. Yeah. If you take out Tether, it's number 4. That's impressive. Wow. It's over XRP. Incredible. Look at the market cap of this thing. 44.5 billion. Wild. What a move, right? Incredible. Solana has been the absolute star of this run up, of this crypto. This is an alt rally, by the way. People talking about alt season. This is alt season. What the fuck do you think this is? What do you think this is? You don't think this is alt season? Look at Bonk. This has been the undisputed star of alt season. And it's really fitting, isn't it? It's fitting that it's Solana, because Solana was the coin most associated with the biggest Ponzi crypto scam theft in history last year. And just 1 year later, it is the undisputed star of a ridiculous shitcoin vapor crypto rally. Incredible turn of events. That the ecosystem most destroyed 1 year ago is the one leading the charge 12 months later. Crazy. All right, let me go back in the chat. Let me catch up with everybody. I've been talking for almost an hour. Holy shit. Sick Thinker gifted another membership. BCB joining the Founders Club. What up, my dude? Yay. Tiku joined. Thank you so much. I need to change this from welcome to supporter. Maybe I need to change it to like welcome to the soup kitchen. Something like that. I'm scrolling through the chat, making sure I catch up with everybody. Big Shroom says, thanks, Alpha Beta Soup, for your content. I appreciate you being here, Big Shroom. Sick Thinker gifting another membership. Super generous, man. Appreciate you so much. Oscar Hernandez gifted a membership. Welcome, Nick Droy. Welcome, everybody. Sick Thinker says, you get smashed on Twitter. Yes, I absolutely do. So let me show you one of my most recent tweets that I got smashed on. This is something I said the other day. This is the Twitter summation of my opening monologue about going into next year. Everything that was heavily shorted or beaten down has been ripping into end of year. That's what EOY is. Former SPACs, small caps, you name it. In fact, pausing on that. In fact, this move on the Russell right here, this is one of the strongest moves in the history of the Russell. It went from a 52-week low close to a 52-week high close in like 6 or 7 weeks. That's the fastest it has ever done that. And people think this is the beginning of a new bull market. That's not what I think. Everything heavily shorted or beaten down has been ripping into the end of year. Former SPACs, small caps, you name it. We have a total bottom feeder shitcoin crypto rally with Vapor doing 40x's on multiple chains. Base, Solana, every chain has got somebody ripping. Record ETF inflows in equities. We've looked at that together. Max long positioning. We've looked at that. Short volatility to eternity. Short vol to eternity. The VIX is at 12.5. High volume of corporate debt Ponzi-nomics to delay interest costs. What have we been talking about with all these Bloomberg stories? Sorry, I'm bouncing around. Widespread excitement for 2024. Soft landing is global consensus. Return to normal rate cuts are global consensus. You might be wondering what the fuck that means. We looked at this last week. This showed what markets thought we'd get with rate rises in 2023. What actually happened in 2023, every single country was wrong to the upside. And now for 2024, every one of them, with the exception of Japan, now expects large rate cuts. This is the return to normal trade. This fall on the 10-year is the return to normal trade. This rip on the NASDAQ is the return to normal trade. This rip on the fucking Russell is the return to normalcy trade. Everything is trading that way. Bulls are chads, bears are fucked. We have figured out the cycle and we're all riding to Valhalla together. This has every characteristic of a blow-off tail in a gargantuan speculative cycle that has convinced many people it's the start of a whole new one. Next year could be fucking wild. I believe this wholeheartedly. A bunch of people don't agree with me. Some people did. But this kind of sentiment, this kind of behavior, we just had GameStop was just in the news because they had a bunch of extra money and they were just going to invest it in equities. The CEO wanted to invest their money in equities. That's very reminiscent of the real estate bubble in Japan in the late 80s, where companies started using their cash flows to invest in real estate because they assumed it was a can't-lose bet, rather than continuing to invest in their own capex and future production. There are stories about that in the book Manias, Panics, and Crashes. I can read an excerpt about that for you guys later. But you see a lot of this behavior near the ends of a cycle. This is absolutely a late cycle phenomenon. We have endured almost 2 years of Fed tightening. We have unemployment at secular lows, secular meaning long-term trend, right? Multiple cycles. We have unemployment at secular lows. We have created inflation in this cycle. We have a bunch of debts that were created from the prior expansion that are being held onto with white knuckles, hoping for rate cuts. And we've got a bunch of businesses now taking out additional debt at higher interest rates, because that's what these private credit loans are. They are higher interest rates in an effort to defer their debt costs another year or two, because everyone is praying to Christ that Daddy Fed is going to come save them. That's what this is. If there is anything remotely short of these expectations and this right here, or maybe even more, if there's anything short of that, corporate America is in real trouble. If there's even the briefest deterioration in consumer spending, which has already started to slow down, right? Black Friday spending, holiday spending was negative in real terms year over year. Holiday spending grew by like 3%. CPI on average this year was above 3. So that's negative on real year over year terms for holiday spending. Don't get caught up just looking at the S&P. Don't just watch the S&P and non-farm payrolls, or you will be left holding a bag. You have to look elsewhere. JB Estrada says, I'd love to hear a conversation between blockchain backer and Alpha Beta Soup talking about their biggest mistakes that helped them grow and develop their investment skills. Well, that's a nice thought. I talk to BCB a lot. I'm no master investor. You know, I'm quick on my feet. I'm eloquent. I can explain things well, but it doesn't mean I've got everything figured out. It doesn't mean I'm making tons of money, that I'm, you know, some like super rich, savvy investor guy. I'm totally not. I'm just a dude who is constantly second guessing himself and makes plenty of mistakes even today. Right. So, you know, there isn't just some one big lesson I learned to figure everything out. I haven't figured everything out. If I had, I'd be a much more profitable trader at this point in my life. That's why I'm always telling people not to listen to my like trade calls. That's why I don't even share that many of them, to be honest with you. Scrolling through the chat, seeing if I find anybody's questions or anything. I don't want to miss anyone. Sick Thinker says I have a private jet. All right, let me show you something. I want to show you guys a chart. Here it is. Okay. I think that this chart perfectly sums up why it is so hard to use the stock market as a gauge of the economy, and why people are so convinced that everything is fine. What this is showing is we have 5 lines. We have 5 lines on here, and each line represents an era of time. There are multiple cycles inside each one of these lines, with the exception of the black one. The black one is today. Well, 3 of these lines have eras in them, sorry. The green line here is the Greenspan era. It has the 1990 recession in it and the tech bubble recession in it. That was when Greenspan was the head of Federal Reserve. The red line is called the inflation era. It goes from 1969 through the Volcker era. QE, what I'm calling QE, is basically the Great Financial Crisis and COVID. Those 2 recessions are in the blue line. The purple line is the soft landing example that we've been using as our anchor for what a soft landing could look like, 1966. And today is in black. Now, if you start from right here, let me get my drawing tool. If you start from right here, this is the beginning of the yield curve inversion. This was when the 10-month, 3-year, or sorry, the 3-month, 10-year yield curve inverted in October of 2022. This was October 22. This is the S&P's performance since then. This purple line is the S&P's performance after the yield curve inverted in 1966. The red line is S&P performance after the yield curve inverted in these 2 recessions. There's 3 recessions in there. Sorry, 3 or 4. This green line is what happened during the Greenspan era when the yield curve inverted. And the reason I think this chart is so fascinating is because you have today, the QE era, and the one shining example of a soft landing all up here, right? But then you have a whole cluster of recessions down here. And what this really is showing to me is that in the QE era, Since we've invented all these new financial tools and levers to stave off crisis and to juice the system, since then, a yield curve inversion that leads to a recession, which it did in both of these instances, is absolutely indistinguishable from a soft landing if you're only using the S&P as your guide. They look exactly the same. I could even make this chart. Let's exclude these. Let's exclude these. There we go. These are when recessions began. I color-coded them. The colors match the lines up here. So the red inflation era, let me move my labels. They moved around a little bit. This red line encompasses all of these recessions. And they all began at these points in time. Now you can see we're up here. There's still some examples of recessions out ahead of us. There are 4 of them in the red line. There are 2 of them in the green line. There are 2 of them in the blue line. But the S&P has been performing really strongly since October of last year when the yield curve inverted. It's exactly what happened in 1966. That's also what happened in 2007 and 2019. The yield curve inverted, equities ripped. And in 2 of those cases, we still had a recession. In one of them, we did not, but we had one over here. Like this ends in like December of 1967 or something like that, 68. Wait, hold on, let me think through this. This is 24 months. This is 1968. We had a recession in 1969. Like the end of this purple line is only about a year away from when we actually had a recession. So they kicked the can, or they avoided one in 66. We just had one 24 months later. But still, I think that this shows you how there's so much infighting and dispute about where the economy is today, because there's a lot of people that are using the stock market as some kind of a barometer for what could happen, but it could not be further from telling the truth. And it's not representative of the economy really in any way. And in the QE era, which this is part of, stocks perform well when the yield curve inverts, and it looks like a soft landing. But recessions come anyway. And most recessions begin with the market at their highs. We went through the timeline last week. I'll do it one more time just because I think it's such an amazing example of how the cycle plays out. I'll briefly just kind of blast through it real quick to show you guys, because I want this to hit home. And let me slap the recession on there. Right. So the Fed, back in 2006, 2007, we started having subprime lenders lending to homeowners. They started failing back here. This is kind of like, how we had the regional banks collapse earlier this year. There were a bunch of subprime lenders that began failing in 2007. And in the middle of that year, the Fed started talking about different facilities and things to help out some of these lenders so that they didn't turn into more of a systemic crisis. Somewhere around in this period of time right here, Bear Stearns, who was a major investment firm, they had a couple of their funds go belly up because they were invested in these subprime loans. Well, some time went by, and then the Fed started cutting rates. Here's Fed funds down at the bottom. And right around this time, right in here, September 2007, the Fed started cutting interest rates. We had some lenders that had failed a few months earlier. Bear Stearns had their firms go under because they were exposed to these things. And right in here, the Fed started cutting Fed funds. This was the all-time high. 1 month later, in October, Fed cut, market rips, all-time high. Fast forward to February of 2008, somewhere around in here, Ben Bernanke went in front of Congress and said, I don't think we're going to have a recession. I showed you guys last week the news story from this period of time where he did it. You can go read his speech on the Fed website because it's part of the public record. And he said, I don't think we're going to have a recession. We just might have lower growth. Somewhere right in here, Bear Stearns who had this fund that went belly up that was exposed to these subprime lenders, Bear Stearns collapsed right in here. If you've ever seen The Big Short, that's the firm that goes under while Steve Carell is sitting on a stage talking to people about all of the corrupt and toxic business practices going on. And at that moment, everyone's checking their phones because they're getting text messages because Bear Stearns is collapsing in that moment. That was right here. Lehman was not for another 6 months. We had all this time in between. The recession began in December of 2007. The NBER didn't tell us that it was a recession until December of the next year, 2008. And oh, by the way, unemployment kept on rising and didn't top out until back here, until after the recession was over, until after the market had bottomed. We still had more unemployment. This whole process was over 2 years. The Fed tightening began way the fuck back here. Like they started tightening in 2004 and they tightened all the way into 2006. This was the Fed tightening. Up here, let me clear some of this off. This was the Fed tightening. This was when they started easing. The market still ripped and we still had a recession. They cut the entire way down. So I present these because I think it's a fascinating case study in how long a cycle can take, how there can be many turns along the way where you think you know the outcome, but you're wrong. It's got all of that, but it doesn't mean that we're going to play this out exactly. We're not setting up for the GFC to happen again in the way that it happened. We don't have a bunch of subprime home lenders having their loans packaged up and resold to various commercial banks in like some huge house of cards, Ponzi-nomic style. Like it's a little different this time. We got things spread out in private credit. The subprime loans are mostly auto loans, not home loans. It's a different setup. But the length of time that it took, the 2.5 year process of thinking maybe something is wrong, actually seeing things wrong, but it not manifesting in a full-blown crash, and then 6-9 months later it actually happens. That is a process we should all be keeping in the back of our minds. That's why I say things like, next year could be fucking wild, because everyone is on one side of the boat. And if you recall back to the beginning of our stream, when we were discussing the end of this past year, this moment in time right here, as we entered into 2023, everybody was on one side of the boat right here. Everybody was in recession camp. We're going to fucking zero. This is the biggest crash in our lifetimes. Everything is going to be, worse than the great financial crisis. We had the gilt market blow up in the UK. We had interventions from the Bank of Japan. We had the equity markets all kissing their 200-week moving averages. Dow Jones did it. NASDAQ did it. S&P did it. Everyone was hella bearish. We had crypto blow up like right in the middle. And now as we enter 2024, 1 year later, everybody is on the other side of the boat now. Everyone over here was scared and bearish and oh my God, we're going to zero. And now we're up here. Everyone is the polar opposite. We're going to have 12% earnings growth next year. We're not going to have a recession. The Fed's going to cut 200 basis points. Credit is going to spin back up. All the businesses are going to be fine. The consumer has tons of money. Household net worth is at all-time highs. Let's fucking go. I hear the household net worth one at all-time highs a lot. Household net worth is always at all-time highs. I hear that one a lot. Households have highest net worth ever. New all-time highs in household net worth. They're fucking always at all-time highs. Always. This is a log chart, by the way. Very few exceptions. where years began with household net worth below all-time highs, and most of them were already in a recession. Every other instance, they've began at the highs. It doesn't mean anything. It's just things people say to themselves. It's like when people say things to themselves like, well, there's 900 Bitcoin mined a day, and after the halving, it's only 450 Bitcoin. And so that sell pressure is getting cut in half. Thus, the market will have to rise because demand is... People come up with all these stories about why things have to happen because there's XYZ factor. And it's just not true. But the economy, it's got electrolytes. That's funny. So I think the real question for us is not about equities. I mean, we could wait for some kind of an event to surprise us. But I think the thing that I'm going to be watching the most is jobs. I'm going to continue to watch the labor market. And I'm going to wonder when it is that unemployment or labor becomes nonlinear, because that's really what we're waiting for. Excuse me, I got the hiccups. Haha. Because if we look at the unemployment rate, this is really what this one does a better job of capturing it. There is a moment when labor becomes nonlinear. Do you know what I mean by that? This is linear. This is nonlinear, right? Linear is it just goes in a steady rate of change over time. Nonlinear is that. Which of these two lines, of this one and this one, which one of these two examples represents what labor does in a recession? It's this one. It's the nonlinear one, right? It doesn't. Unemployment doesn't do this. Unemployment does that. Look, every single time. Every time it goes up by an average of 3%. If we get that this time, we're looking at 6% unemployment. That would be like 4 million people out of work. Because we have a labor force, the way you do that math, look at the labor force, 168 million people. So if the unemployment rises 3.3%, it's 5 million people. So it's this is the thing I think is the question mark, is like, what causes this to become nonlinear? Do we get a surprise? Is there a private credit firm that goes under because some of its loans go bad because they have been reducing risk? Because they've been allowing funds to pay debt interest with more debt that is higher yield? Is it something like that? Is it some surprise in geopolitics? Or is it just the continued deterioration of earnings from a consumer who is running out of liquid savings and whose costs are continuing to rise? You know, groceries are 20 to 30 to 50% higher than they were 2 years ago, and almost no one's income is that much higher. These are some of the things I have in mind going into next year. I do think we've got more room to go on risk assets, right? We have the ETF coming for Bitcoin. It's assumed that it will be approved somewhere in the first couple of weeks of January. At least that's as soon as it can be approved. January 8th to 10th is the window that it could happen the soonest. I think we have room ahead of us for equities to continue to go higher. We have this setup to complete, right? This multi-cycle secular expansion of the NASDAQ and the Dow still has room to go, another 4 to 6% collectively. That could happen in 1 month. It could happen in 2 months. It could happen in longer than that. Maybe it, does this and it takes 6 months. I don't really know. But what I do know is that we're right at the beginning. We're right in the early stages of when recessions normally happen. We have multiple examples out ahead of us, and job growth continues slowing down. So that's what I'll be watching going into 2024. And I think keeping your ear on the alert for things related to private credit. Listening for stories along those lines could be a way to watch for something that there are just not a lot of people paying attention to this part of the market because it's opaque, because it's not exciting to talk about, and because unless you work in it, you just don't really know that much about it. It's really easy for folks to just kind of not give it any attention. But I've been giving it quite a bit of attention, and I think that there are risks here. I wonder if the weak labor market means less unemployment. No one can hire as is. It's possible, Amory. I think there's an obvious tightness in labor, and part of it is because of demographics, because population growth has slowed down, because we have a bunch of retirees, and so there's kind of a generational handoff going on, and that doesn't happen very often. But because it's happening right now, and because we just came out of a period of massive overstimulus, it's created an incredible tightness in the labor market. And it's allowed the Fed to do some of what it's done without labor completely collapsing. If it didn't have this built-in strength where we had so many job openings, this number is not perfect, but you can still gauge it relative to the past, and it's still elevated relative to the past. This has allowed the Fed to do some of what they've done. And it's been part of the reason why the labor market has been able to hang in there, because they had far excess demand for what the supply of labor could fill. And so the Fed's been walking this number down and thinking that they could just walk it all the way back down to, cycle highs and not create any unemployment. That has so far been proven true on a national scale. But that doesn't mean the cycle is over, because in a lot of ways we've crossed the Rubicon in a lot of areas, in pieces of labor that we've looked at here on the channel: job losers, job leavers, part-time for economic reasons, temporary workers, the amount of hours being worked across multiple sectors. These are things we've explored together. And all of those have kind of crossed the Rubicon in terms of rate of change. And they eventually have a way of bleeding into the unemployment rate. We just haven't seen that yet because of the secular tightness. It doesn't mean we can't have unemployment, but I think it just means that the market it would require more pressure before it actually snaps. Maybe we get that in 24. Maybe we don't. Like, I could be wrong about everything I've said for the last hour and 20 minutes. Certainly, I could. I don't know what's going to happen. No one does. I'm just trying to present the risk factors. It's really easy to be bullish. Everybody is bullish. And I'm not always bearish. There's a time and place to emphasize one's bearishness, and there's a time to recognize when your thesis might not play out for some time. 6 months ago, 9 months ago, that's the place I was in. I didn't think it was going to happen right away, but it was months ahead of time. And so I was always pushing back on people's narratives that we should be in a recession right now. No, we shouldn't be. We're not. This is way too early. All of you are way too early. It's ahead of us. Well, now we're there. Now we're on the doorstep of when it's most likely to play out. And so the next half a year is game time. It wasn't 2023. It's now. And these periods of time are often when the market is the most irrational. So it's the hardest period of time to stay tethered to a thesis that is grounded in data, because people's emotions are getting way out ahead of what's true. So that's why I don't listen to a lot of people on Twitter. It's why I've been scrolling less. It's also why I've been sharing a little bit less, because I'm not adding a lot of value to the conversation, because everyone just believes what they believe, right? I'm not going to change people's minds with a tweet. But I try to put my ideas out there so people know what I'm still thinking about, and know that nothing's really changed with me. Nothing's really changed with the economy. Some things look better. Some pieces of the economy, like the cyclical pieces, they're picking up a little bit in rate of change terms. But because credit has been totally choked off, And as we spent a lot of the earlier part of the stream talking about, we have this refinancing wave that is yet to come. This is a story that is not over yet. And so, just to play this one last time.
Restrictive in and of itself, that spread
Just
between the
this.
10-year and Fed funds.
Yeah, I mean, the higher for longer is when it starts to really bite. And the reason we didn't have a problem this year is because we haven't had to refinance corporate America yet, right? That's next year's business, right? I mean, people have termed out their debt. By the way, most consumers' biggest, debt is their mortgage, which is fixed. So that's why it hasn't really started to bite yet. But it is starting to bite now. It's starting to bite on interest rate sensitive demand. For example, housing demand, auto demand, anything that requires, borrowing, that really is falling off a cliff now. So next year, if the Fed doesn't cut significantly and 10-year is 4% or higher, and you got to recapitalize corporate America and the Treasury, okay, that's the big one. If you got to recapitalize the Treasury at 4.5%, 5% over the next 12 months, that's a lot of money. You're going to crowd out a ton of investments. So that's why the soft landing is actually probably the worst possible scenario for stocks. It's because the Fed can't actually cut enough to create the windfall that we need, or the tailwind we need for all this refinancing. It has to happen in 24 and 25 and 26.
Boom. That's literally what we've been talking about on here. And seeing someone so respected like Mike Wilson articulating the exact thing we've been studying for the last few weeks makes me think that maybe we've got our finger on the pulse here. And I don't see a lot of other people talking about this. So that's what I'm going to continue to pay attention to going into next year. That's what I got my mind on. So it looks like the number of likes has a 1 on it, but there's 220 of you watching. We need to have at least 200 likes on this bad boy. So slap your hand on that thumbs up button. We got 147 likes. That means there are about 60 of you that need to do a little work for me. The soup has been served. It is hot and steamy. It's nice and chunky. There's little bits of meat in there. There's some potatoes. You got a big old spoon. Just hit that like button, baby. So going into next year, what we're going to start doing is we'll do a member stream tentatively once a month, but we'll just that's just having never done one. I'm going to say tentatively once a month, and we'll see how it goes. If they're a big hit and it's easy to do them, then we'll do 2 a month or something like that. We'll continue to do the weekly public stream, this one you're watching right now. I'll try to work on making certain ones more structured. I don't always do that. A lot of times I just want to sit down and just kind of free flow, walk you through what I'm looking at, what I'm thinking about, the charts that are most top of mind, because it kind of keeps me loose. If I have too much rigidity in scheduling, then my creativity goes down. But I do think I need to structure a couple of topics to talk about in some streams early into the year. So maybe we'll do that. There's been some requests to do a little bit of monetary history. So we may have a stream where we talk a little bit more about those things. I don't know if we'll do a whole hour and a half on it, but we'll talk more about that. I have some things that we can share, some cool parallels where you even, like if you study different eras, you study ancient China, you study the pre-revolutionary colonies in the U.S., you study the early 1800s period of the U.S. when they were trying to establish their banking institutions, their banking sector, and then you look at eras today. There are all of these really interesting parallels, and even some of the exact same language used to describe what the government tries to do when the people discover that they have a very bad money on their hands. And there's just a lot of fascinating overlaps on the big Venn diagram of monetary history. And so that's some stuff we could look at together. Maybe we will. It's not as visual. It's more of a think piece kind of thing. But there's been some requests for that. So we'll do that. Maybe we'll do a stream that's more focused on like trading and things like that if people want to do that. I don't know. I'm open-minded. I also need to get back and do a little bit more BTC on chain. I've been kind of neglecting that, but if we are starting to see an acceleration in the cycle a little bit and we're trying to look for more bullish biases, we could glance at some on chain. It isn't going to lead the market. It's more of a fundamental bias check for when you have a technical expectation. But I think we could look at some on-chain stuff too. Lincoln's greenbacks. Yep. Greenback crisis. So I think it's about the place that we'll wrap it up today. Got a lot of my thoughts out there. We talked about a few different things. If you're not subscribed to the channel, please do so, but I assume most of you already are. If you want to be a part of the membership streams, that requires joining the YouTube subscriptions, which are enabled on the channel. If you go view the channel, that's what turns everyone's names green in the chat. I reached out to somebody about creating some emojis for the channel. It's just their holidays, and so it might be another week or two before I get those out. But yeah, we'll just keep trying to build this thing into something entertaining and valuable for all of you. I think when we do the member streams, they'll be a little bit even less structured than these are, and we'll just kind of get to know each other a little bit. We can have a little more back and forth. I won't just come on with some hour-long monologue. We'll have a little bit more interaction, and maybe I can show you behind the curtain a little bit. Maybe I can show you how I put these together, how I built the data set that powers a lot of our modeling, or anything you guys want to look at, within reason. We can probably look at some of that stuff. So with that, it's been a great 2023. I didn't stream a lot the first few months of the year. I was going through some things. And then I lost my job and I realized, I just need to get back and doing the things I want to do. And so the second half of the year was much more rewarding and enjoyable for me as a content creator, even though I get a lot of anxiety about having a large audience. I'm not used to having a Twitter audience as big as I am, but it's a lot more manageable here on Twitter. There's just a couple hundred of you guys. So things that I'm still working through, I'm just human, I'm just a guy with flaws and paranoias. It's all right, BT. Sorry about the job loss, he says. I didn't like that job. I needed to find something else. And, the loss of that job freed me up to think about my life in a more open way. Because I worked there for 11 years. And I'm trying to make it so that I don't have to go back and get another job like that. Because doing that will pull me away from the markets. I won't be able to watch them as much. It won't be as easy to stream. My little depth of my analysis will necessarily suffer if I have a new job. So I'm trying to avoid going back to that. So that's kind of what I'm working on now. I'm just not very good at making money. I'm good at talking, not good at making money. Some people are really good at making money and they just sound like idiots. They can't talk at all. Maybe I need to trade in some of those skills for some more money making skills. So, all right. With that, we're going to wrap up. I love you guys. Thank you for supporting my channel and being here, especially to those of you who come into the chat 20 and 30 minutes before the stream starts to hang out. I love all of you. We'll keep going in 2024. We'll ride this train together and just see where this takes us. Until we meet again, Happy New Year. Have a great New Year's weekend. Next week, I'm going to Las Vegas. Next week, weekend after next. So the next stream will maybe let's see the calendar. I'll be leaving on Thursday, so maybe we'll do the next stream on Wednesday on the 3rd. That's probably what we will do. And then when I come back, we'll do another stream, and then we'll start with the member streams. So, take care of yourselves. Take care of each other. Make sure you're subscribed to the channel and you have the bell icon turned on so you know when I go live again. Make sure you're following me on Twitter. Go outside and touch some grass. Kiss your cat. Call your mom. Some of us can't do that anymore. Sad about it. Call your mom. The holidays are the time to do that. And we will chat again in about 5 or 6 days' time. Thank you very much. Have a great day. Cheers, everyone.